The Lithium Americas Corp stock, trading under the ticker LAC, currently sits at $5.82, reflecting an intraday movement of negative 3.08% as of the moment of this generation, with a daily trading volume around $14.29 million shares. While the market narrative you've likely encountered focuses on the recent volatility tied to the lithium commodity cycle, a straightforward ebb and flow of a speculative mining stock, the deeper, more important reality is that the stock's true story is now less about the commodity itself and far more about sovereign industrial policy and strategic government backing. The price drop today, while significant, might be masking a crucial long-term de-risking event, the substantial $2.23 billion loan from the U.S. Department of Energy, DOE, for its Thacker Pass project. Most investors see the loan as just funding. The sophisticated view is that this loan fundamentally shifts the company's risk profile from a volatile junior miner to an operation with a quasi-governmental mandate, which is an insight that changes the entire calculus of the stock. The fact is, the market expects LAC to move precisely with lithium prices, but the political and strategic leverage the company now holds due to domestic supply chain priorities in the U.S. is the unexpected ace up its sleeve, a factor not easily priced into traditional mining valuation models. This governmental commitment creates a significant buffer against the short-term commodity price swings that often plague its peers, and it's a key reason why institutional investors like General Motors are so deeply involved, having taken an equity stake and secured significant offtake rights. The general belief, especially for those investing through platforms like Robinhood or performing self-investing with basic online investing tools, is that Lithium Americas is merely a leveraged bet on electric vehicle adoption and, by extension, lithium prices. When Tesla stock or the broader EV sector dips, LAC is expected to follow, and the price action today certainly supports this surface-level reading as it trends downward in what looks like a typical resource stock pullback. However, a deeper analysis challenges this conventional wisdom. The recent movement isn't just a commodity play, it's the consequence of the technical noise surrounding a massive capital expenditure project finally moving into the execution phase, punctuated by the news of the first $435 million drawdown from the DOE loan. High-volume days, like the significantly larger volume seen a few sessions ago, often relate more to institutional rebalancing and positioning around these major funding milestones rather than daily sentiment shifts about Apple stock's next iPhone battery or general EV sales figures. What often gets missed in the noise is the sheer scale of the Thacker Pass project, located in Nevada, and its strategic importance. The project is touted as having the largest known, measured, and indicated lithium resource and proven and probable reserve in the world, which positions it as a geopolitical asset for the North American supply chain, not just another mine. The complexity of its development, being a clay-based asset, is what kept many traditional mining fidelity investments and individual brokerage firms on the sidelines historically. But the DOE's financial backing and the commitment from General Motors provides a clear signal that the logistical and technical hurdles are being effectively addressed and mitigated by partners with immense resources. Looking at the immediate stock movement, the decline today, while noticeable, is happening on a volume that, while significant, is currently running below the average daily volume seen during the sharp moves earlier in the month, suggesting it might be more profit-taking after the significant run-up following the DOE loan announcement and less of a fundamental flight from the stock. The stock had experienced an impressive surge of over 140% in its 90-day return just a few weeks ago, fueled by the government support news and the finalization of the DOE loan amendments. A pullback after such a dramatic run is natural, and in many ways healthy for the stock's longer-term chart structure. From a technical perspective, the price is testing support levels established after the initial spike, and the key now is whether institutional buyers will step in to defend this range. We see evidence of this institutional interest in the recent 13F filings, which show significant position additions from major funds even as others reduce exposure. This divergence in institutional activity, some funds adding and others paring back, indicates a significant difference in opinion on the stock's valuation and near-term trajectory. For instance, firms like Van Eck Associates and UBS Group have been adding shares, indicating a conviction in the long-term project viability, likely factoring in the lower cost of capital afforded by the DOE loan versus what they'd get through conventional financing, or even through an online investment platform's margin account. This is the difference between an optimistic retail trade and a highly informed strategic institutional position. The company's business model is now quite distinct following its separation from its South American assets into Lithium Argentina LAR. Lithium Americas Corp is now a pure-play North American entity, singularly focused on the development, construction, and eventual operation of the Thacker Pass lithium project. This hyper-focus on a single, massive, geographically strategic asset is its strength and its principal risk. The strength is the clear domestic supply chain story, making it a beneficiary of U.S. government policy that favors domestic critical minerals. This is a far more compelling narrative than many diversified miners offer, and it's a key reason why platforms like Fidelity are fielding more interest in lithium-focused Fidelity ETFs that have LAC as a significant holding. The risk, of course, is that any delay or technical issue at Thacker Pass has an outsized impact on the stock price, as there are no other assets to cushion the blow. The company aims to produce battery-quality lithium carbonate, targeting an initial nominal design capacity of 40,000 tons per year for Phase 1. The key financial consideration here is that, as a pre-revenue mining developer, traditional valuation metrics like PE ratios are useless. Instead, investors should focus on the project financing, the execution timeline, and the cost curve. The fact that the project is a joint venture with General Motors, who holds a large interest and exclusive offtake rights for a significant portion of Phase 1 production for 20 years, essentially de-risks the demand side of the equation. This kind of guaranteed demand is gold for a pre-production mine, and completely separates LAC from the speculative volatility of companies traded on pure commodity price swings or mere hope. Past performance, while less relevant than future execution for a development stage company, does show the extreme volatility inherent in the lithium sector and in resource project development. The stock has seen swings from a 52-week low of $2.31 up to a high of $10.52. This dramatic range speaks to the market's deep uncertainty, a reflection of the gap between the promised long-term value of the resource and the near-term capital intensity and execution risk. The stock's past performance was tied to a different corporate structure before the separation of the South American assets and before the finalization of the massive DOE loan. Therefore, comparisons to pre-separation metrics must be taken with a grain of salt. Historically, the company has faced significant capital requirements, leading to dilutive equity raises, such as the one in early 2024, which caused a sharp plunge in the share price. This dilution, while painful for existing shareholders, was necessary to meet the equity requirements for the DOE loan and fully fund Phase 1 of the project's capital expenditures. This trade-off between near-term dilution and long-term project certainty is the constant tension in this kind of investment. Looking ahead, the future outlook for LAC hinges almost entirely on the successful and timely execution of the Thacker Pass project construction, targeting initial production by 2027. The catalyst that will move the stock most aggressively is not the next lithium price spike, but definitive, verifiable progress updates on construction milestones, capital expenditure tracking, and continued successful drawdowns on the DOE loan. The main risk remains the complexity of bringing a large clay-based lithium asset into production, which has never been done at this scale in the U.S. There is always the potential for regulatory and environmental delays, though the significant political capital invested in the project by the U.S. government suggests these headwinds will likely be mitigated, not eliminated. The unexpected factor, the reality that exceeds the expectation, is the potential for further U.S. government or strategic corporate involvement beyond the current commitments. The political tailwinds favoring domestic lithium production are strong and could lead to additional non-dilutive funding or further strategic partnerships. This goes beyond the typical mining stock narrative. For the individual investor utilizing tools like a Schwab Intelligent Portfolios or looking for solid companies on investing sites, it's crucial to understand that LAC is not a mature cash-flowing operation like a major Fidelity brokerage holding. It is a high-risk, high-reward bet on a single strategic asset. The next few quarters will be all about construction updates and financial compliance. If the company hits its projected construction milestones and keeps its cost projections in check, the stock is likely to see a significant re-rating as the market begins to price in the certainty of future cash flow from a major geopolitically secure lithium supply chain. However, any slippage on the timeline will be harshly punished. This is a story of a speculative stock being transformed into a strategic national asset, and that distinction is the key to understanding its price action. Comment below. Do you believe the U.S. government's strategic backing fully de-risks the Thacker Pass project, or are the inherent geological and construction challenges still the primary risk for LAC shareholders? The long-term narrative for LAC is one of strategic scarcity value in a commodity-driven world. The expectation is that it's a volatile commodity stock. The reality is that it's a strategically crucial industrial project.